In the world of finance, few numbers have traveled as fast or caused as much unease as the figure now being repeated across investment channels, trading forums, and late-night financial broadcasts: $38,000 per ounce of gold. It is a number so large that it sounds almost impossible. And yet, for a growing number of investors, it no longer sounds like fantasy. It sounds like a warning. The claim itself is simple to state, even if its implications are not. According to a wave of independent analysts and commentators, China is not merely buying gold as a matter of routine reserve management. They argue that Beijing is deliberately, methodically, and quietly preparing for a moment when the global financial system breaks, a moment when the US dollar loses its position as the world's reserve currency, and gold is forced to return as the anchor of monetary trust. If that moment arrives, they argue, the price of gold would not simply rise. It would explode upward toward numbers that most investors have never even considered. This is the story that has captured the attention of business professionals, entrepreneurs, and everyday savers alike. It taps into something deeper than curiosity. It taps into fear, the fear that the financial system many people have trusted their entire lives may not be as stable as it appears. And when fear enters a financial conversation, judgment often becomes clouded. To understand why this claim has spread so widely, one must first understand the environment it was born into. Over the past several years, central banks around the world have been buying gold at a pace not seen in decades. This is not rumor. This is documented, verified behavior, tracked carefully by institutions such as the World Gold Council and the International Monetary Fund. China, in particular, has been one of the most visible buyers, adding to its official reserves for an extended, uninterrupted stretch of time before pausing its public purchases in the middle of 2024. Somewhere inside the vaults of the People's Bank of China, a number is being calculated that could quietly reshape the next decade of global wealth: $38,000 per ounce. That is the figure now circulating among analysts, economists, and increasingly nervous investors. Is it a coordinated signal that the world's second largest economy is preparing for a monetary reset the West is not ready for? Or is it something else entirely, a number built on assumptions that quietly fall apart under scrutiny? By the end of this video, the difference between speculation and strategy will be impossible to ignore. Welcome back to Precious Metals Intelligence, the channel built for those who prefer clarity over noise and evidence over speculation. If you are watching this from your office, your kitchen table, or during a quiet moment before the markets open, thank you for being here. This channel exists for viewers exactly like you, professionals, decision makers, and lifelong learners who understand that wealth is protected through knowledge, not headlines. Numbers rarely lie, but they are often misunderstood. And nowhere is that more true than in the story of China's gold reserves. To understand what is really happening inside Beijing's financial strategy, one must step back from headlines and speculation and look instead at what the verified data actually shows. Since 2022, central banks around the world have been buying gold at a pace not seen in generations. This is not a theory. It is a documented fact, tracked in detail by the World Gold Council. Collectively, central banks purchased more than 1,000 tons of gold annually during this period, a figure so large it reshaped the entire global gold market. Among these buyers, the People's Bank of China stood out. For 18 consecutive months, it added steadily to its gold reserves before quietly pausing its official purchases in mid-2024. For many observers, this pattern seemed to confirm their fears. A powerful rising economic force buying gold month after month without pause. It looked deliberate. It looked coordinated. And to some, it looked like preparation for something enormous. But patterns on their own do not explain motive. To understand why China was buying, one must return to a single event that reshaped how nations around the world think about financial security: the year 2022, when Russia invaded Ukraine. In response, the United States and its allies took an extraordinary step. They froze roughly $300 billion of Russia's foreign currency reserves. For Russia, this was a severe blow. But for the rest of the world, it was something else entirely. A warning. A demonstration of power that many nations had never fully considered before. If a country holds its wealth in US dollars or in US Treasury bonds, that wealth can be restricted, frozen, or made inaccessible, not through war, but through policy. With a single decision, access to national wealth could be limited. China, holding more than $3 trillion in foreign exchange reserves, most of it tied to the US dollar and US Treasuries, took notice. This was not an abstract risk. It was a direct and visible vulnerability, one that had just been demonstrated on another major economy. And so China began to act, not with aggression, but with caution. This is where the popular narrative begins to lose its footing. The claim that China is buying gold to destroy the US dollar assumes an offensive strategy, a deliberate attack on the existing financial order. But the evidence points towards something far more restrained. Every financial theory needs a foundation, some form of calculation that gives it the appearance of certainty, and the theory behind $38,000 gold is no exception. To understand why this number holds such power over public imagination, one must first understand exactly how it is calculated, and more importantly, what assumption it depends on to remain true. The formula itself is not complicated. Analysts who promote this figure begin with a measurement known as global M2 money supply. In simple terms, this includes physical cash in circulation, along with money held in checking accounts and other easily accessible funds across the world's major economies. This total figure is enormous, representing the combined liquid wealth of nations. From there, the calculation divides that number by the total amount of official gold held in reserve by central banks around the world. The logic behind this equation rests on a single dramatic premise, that if the global financial system were ever forced to return to a full gold standard, one where paper currency must be fully backed by physical gold, the price of gold would need to rise dramatically to make the math work. Under this scenario, gold would not simply increase in value. It would need to absorb the entire weight of the world's money supply. According to this formula, that weight translates to approximately $38,000 per ounce. On paper, the arithmetic is technically consistent. If one accepts the starting assumption, the final number does in fact follow logically. This is precisely why the claim has spread so effectively. It appears mathematical. It appears objective. It appears to be the product of careful analysis rather than speculation. But an equation is only as strong as the assumption it is built upon. And this is where the theory begins to weaken considerably. The entire calculation depends on one condition, that a full return to a gold-backed monetary standard is not only possible but likely. This is where economic history offers a clear and sobering answer. No major government today, not the United States, not the nations of the European Union, and certainly not China, has demonstrated any genuine intention of returning to such a system. The reason is not ideological, it is practical. A gold standard, by its very nature, restricts a government's ability to respond to financial emergencies. Under a strict gold-backed system, a nation cannot simply print additional currency during a crisis. It cannot lower interest rates freely, issue economic stimulus, or provide emergency support to struggling banks and industries, unless it can first acquire additional physical gold to match that new spending. In a modern economy, where crises can emerge suddenly from pandemics to financial collapses to global conflicts, this level of restriction is not simply inconvenient. It is, for most policymakers, considered dangerous. History offers a useful lesson here. During the Great Depression, the nations that abandoned the gold standard earliest were also the nations that recovered most quickly. Freed from the constraints of a fixed gold-backed currency, they were able to adjust monetary policy, stimulate economic activity, and respond directly to the crisis in front of them. Those that remained tied to gold for longer faced slower, more painful recoveries. This historical pattern has not been forgotten by modern economists or policymakers. It forms the foundation of why virtually every major central bank today operates using flexible, fiat-based monetary systems, rather than rigid, gold-backed ones. The ability to respond to crisis, to adjust policy in real time, is viewed as an essential tool of economic stability, not a weakness to be corrected. This reality creates an important distinction, one that is frequently lost in the excitement surrounding the $38,000 prediction. The mathematics of the formula may be internally consistent, but the assumption powering that formula, a full and voluntary return to a gold standard, is not supported by the actual behavior, incentives, or history of modern governments. It is a compelling number, built from real data, arranged around an unlikely premise. And for investors evaluating serious financial decisions, understanding that distinction is not a minor detail. It is the difference between recognizing genuine strategic risk and reacting to a mathematical illusion. The following section will examine why this becomes even more apparent when applied specifically to China's economic position. If the mathematics behind $38,000 gold rests on a shaky assumption in general, it becomes almost impossible to defend once applied specifically to China. To understand why, one must look beyond gold entirely and examine the true engine behind China's modern economy, manufacturing, and exports. For more than 4 decades, China's extraordinary rise has been built on a single consistent strategy: produce goods efficiently, price them competitively, and sell them to the rest of the world, particularly to Western economies with strong consumer demand. This model has lifted hundreds of millions of people out of poverty and transformed China into the world's second-largest economy. But this success depends on one critical factor: keeping the cost of Chinese goods low enough to remain attractive on the global market. To maintain that advantage, China actively manages the value of its currency, the yuan, keeping it relatively low compared to the US dollar. This is not a hidden policy. It is a well-understood and deliberate economic strategy, one that has shaped global trade patterns for decades. A weaker yuan means cheaper Chinese exports. Cheaper exports mean continued demand from international buyers, continued factory production, and continued employment for tens of millions of Chinese workers. Now consider what would happen if China attempted to back its currency with gold, particularly at a valuation near $38,000 per ounce. Under such a system, the yuan would not weaken. It would strengthen dramatically, and likely very suddenly. A stronger yuan would make Chinese exports significantly more expensive on the world stage. Manufacturing costs that once gave China a competitive advantage would evaporate almost overnight. Global companies currently operating factories across Chinese provinces would face a difficult decision. Faced with rising costs, many would begin shifting production to more affordable manufacturing hubs, including Vietnam, India, or Mexico, a trend that has already been quietly accelerating due to shifting trade policies and tariffs in recent years. A gold-backed yuan would not slow this migration, it would dramatically speed it up. The consequences of that shift would not be limited to corporate boardrooms or trade statistics. They would be felt directly across Chinese communities, where manufacturing remains a primary source of employment. A rapid loss of export competitiveness could place enormous strain on an already sensitive domestic economy, one that policymakers are currently working to stabilize amid ongoing concerns about slowing growth and deflationary pressure. There is a second, equally important obstacle standing in the way of this theory: China's tightly controlled financial system. A genuine functioning gold standard requires free and open capital movement. Citizens and institutions must be able to freely exchange currency for gold and freely move that wealth across borders without significant restriction. China's financial system operates under the opposite principle. Strict capital controls are firmly in place, specifically to prevent large-scale movement of wealth outside the country. These controls are not incidental. They are a deliberate and essential tool used by Chinese policymakers to maintain financial stability and prevent capital flight, particularly among wealthier citizens seeking to protect assets abroad. For China to adopt a truly gold-convertible currency, it would need to dismantle these very controls, effectively opening the door to exactly the kind of capital movement its financial system has been carefully designed to prevent. This would represent an enormous and unlikely policy reversal, one with far-reaching consequences for financial stability within the country. Some analysts suggest China could adopt a symbolic or partial gold standard, one that carries the appearance of gold backing without full convertibility. In such a scenario, the government would maintain control while creating the impression of a gold-anchored currency. Even this softened version, however, would offer little practical support for a valuation near $38,000 per ounce. When viewed through the lens of China's actual economic priorities, protecting its export engine, maintaining employment stability, and preserving strict financial control, the theory of a deliberate full-scale gold standard becomes increasingly difficult to justify.